Well, here we are again. The January 29th Bank of Canada rate announcement is upon us. I'm joined by, as always, by Vaughan Zawadzki and our co-host, special guest co-host, Tom Miocevich. And we're going to break down the meeting and what it means for Canadian borrowers. And let's go. All right, welcome, guys. So big announcement, largely expected. I think it's 99% chance that there's a 25 basis point rate cut. Vaughan, how are you feeling about this one?
Yeah, I'm aligned with that. We're on the trend of rate cuts, which is fantastic. I predict many more, but I mean, it's as weird as it gets in terms of, the economic climate and the regime change in the US. And, the guy tweets out anything that he wants and everybody scrambles, and that's where we are. So I don't think the Bank of Canada can do a whole lot more than that for today. But I think the trend will be to continue to cut. Tommy, what do you think?
Hey, well, thanks for having me on, guys. I really appreciate being here, and it's great to see you guys again. And some of the listeners that you guys don't know, the three of us actually work for the same brokerage, so we have some camaraderie with us. But yeah, back to what I think regarding the rate announcement. I agree. I think it's going to be a quarter point reduction, and really, in order to predict the future on future rate reductions, I think we're really going to have to look down south to see what their next moves are, or even what the chatter is down there before even making any further rate reductions. But for today, mine's a quarter point.
Yeah, maybe we can get the live audience. Anybody following us here on Instagram, feel free to chime in with what you think it's going to be. Is it going to be 25? Is it going to be 50? No change whatsoever. I know, as what you said, Tom, with the U.S. Federal Reserve, it's almost guaranteed that there will be zero change. I think it was at 99, 95% last I checked that there's going to be no change to their federal policy. So we might be going further away from their policy, which does happen historically, but not for long periods of time.
Yeah, because I mean, historically, that's going to shrink our dollar, and I think we're under 70 cents still right now. So that's not super ideal, because it's going to drive costs of everything else up. So we may hit a pause after today, but I would say that definitely today 25 beeps, and then going forward, really hard to say.
Yeah, Chris online, let's just watching the comments here. Chris Marinacos says 25 basis points, and so, as expected, the Bank of Canada reduces the policy rate by 25 basis points to 3%, and ends quantitative tightening. What are your thoughts, guys?
Well, tightening quantity, does that mean that they're going to be stopped purchasing bonds?
That's what it means. Essentially, they're going to stop. Purchasing bonds. They're going to stop essentially putting money into the economy or taking money out of the economy.
Yeah. Well, I think that what that means then for fixed terms, right? Because the fixed rates are based off of bond yields. So if there isn't going to be an influx of bond purchases from the government, we might see potentially the bond yields sort of staying flat for the next little while.
Yeah, I mean, that's a good point, right? So variable drops by 0.25%. And I know we hear this all the time, is that, well, my variable rate dropped, the fixed rates should be dropping as well, right? Well, that's not necessarily the case. It's going to be $15 for every $100,000 in mortgage borrowed. But the fixed rates aren't based on this decision whatsoever.
Mm-hmm. Now, what I think too, there's a lot of margin there between bond yields and what the banks are actually offering on fixed terms right now. So I think now that the dust is going to settle a bit with the bond yields, that we might see some additional pricing, some additional discounts coming from the banks, from the 6 major banks. So even though we don't see it necessarily on bond yields, we might actually see it coming from the banks who are going to discount more, let's say today, than they were yesterday or previous months. Again, that's just what my prediction is.
I mean, I think rates do still have a lot of room to come down. I think from our perspective in the mortgage and real estate environment, we still need rates to come down in order to resume the previous affordability, because we're not there yet. The stress test is still limiting people's borrowing resources. So that may come into play. It's not a direct result of a Bank of Canada rate cut. It's not a direct influence on policy rates and fixed rates for mortgages, but we kind of know in the back of our mind that we need it to happen in order to get this market, not even cooking again, but we need to warm it up, right? And we're still, we've taken the steak out of the fridge, but maybe it's come up to room temp, but we got to get that grill fired up now.
So you're comparing the Canadian economy to a cold piece of meat right now?
The housing, real estate and mortgage market. Yeah, for sure. It's the cold meat. It's out of the
throw it in the microwave. That's what you do with your steaks, right?
Well, it's funny. I just saw a TikTok yesterday with someone taking a frozen steak and putting it in the air fryer for 8 minutes, and it was the best steak ever. So
delicious.
Maybe that's going to be
that's maybe
it's going to be the best ever for our market. But one thing I wanted to add is with the U.S. and the Fed Reserve and them reducing interest rates. One thing that really doesn't impact them as much as it impacts us Canadians when it comes to our mortgages is that we have short-term fixed mortgages, right? So 1 to 5 year. So you see how quickly 5 years went by, right? Like COVID was 5 years ago. So a lot of people's mortgages have come up for renewal or are coming up for renewal, whereas down in the US they'll have 25, 30-year fixed terms. So a lot of them haven't been impacted. So I see the reason why the Fed might not necessarily reduce the lending rate, because it's not really impacting a lot of the current homeowners, but it is definitely impacting their purchases. I was talking to our broker owner Chris yesterday, and he was mentioning that in the U.S. they had something like 4 million units sold last year, whereas in previous 2021, 2022 it was closer to 6 and above million, right? So they're definitely struggling down in the U.S. when it comes to new purchases and stuff like that. So I guess it's really going to be up to the Fed Reserve down there to balance that out. Because if you look at sort of their inflation numbers, there really isn't any need, and their economy, there isn't really any need for them to be reducing interest rates as quickly as Canadian, as the Bank of Canada.
And they're not really expected to reduce interest rates there from the Fed. I have read that housing is taken a bit of a slowdown. And you're right about the 25, 30-year terms. So essentially everybody in the US all kind of has the same interest rate at almost any given time, right? Because you can always refinance into the lowest rate possible and then hold on to that low rate for the next 27 years of your mortgage term. And that's really what happens. So they don't have that mortgage interest rate sensitivity that we do on our 3 to 5 year terms that we're constantly having to renew and look at rates, which is largely why I predict, a lower rate environment for a longer period of time, because we hold some of the highest household debt, including mortgage debt, of any country in the world. We can't sustain high mortgage interest rates for a very, very long term with the size of the mortgages that we take out, especially in the GTA and Greater Vancouver markets.
Yeah, I mean, they get locked into their housing, right? So you're not going to move when you've got such, a sub 2% interest rate. You're going to get locked into that, and you're not going to move. And that's why a lot of the the U.S. economy or the U.S. housing doesn't move in that same direction. But our rates here in Canada, our fixed rates are really based on that U.S. economy. So if they don't have a need to reduce rates, their inflation's looking good, their job numbers are looking good, we're not going to see the same decline in our fixed rates as because we're so heavily influenced by what happened there. So 25 basis point cut from the Bank of Canada today. The policy rate now is 3%. The variable rate now will be 5.20%. The banks are all expected to cut in that same amount. So that immediately does put money in the pockets for Canadians. But I don't know if you saw this. Scotiabank is making a bold prediction. They think this might be the last rate cut we see. So Derek Holt, who is the chief economist at Scotiabank, argues that consumer spending in Canada is much more resilient than the spending stats are suggesting. So even though the $67.6 billion in retail sales in November was flat, a great deal of consumer spending doesn't get captured in Statistics Canada's retail sales report. So this includes airfare, restaurants, bars, concerts, sporting events, hotels, financial services, and more. Is Scotiabank right? Or will we continue to get more rate cuts going forward? Vaughan, I know you've got a strong...
I don't know where... Obviously, I'm on the record for saying that we'll get down to a 2% policy rate. So that I'm sticking with that. And Scotiabank... Yeah, they predicted that through the end of the balance of this year, 3% policy rate, we're done for the entire year. I don't know about this consumer spending data. If it's cut off in November, we don't have the numbers from Christmas. Obviously, we have the GST, HST holiday that probably spurred some short-term spending, which is probably not indicative of the market overall.
Sorry, that might have been December's. I think I misspoke there. It was December's numbers.
Okay. I mean, December is typically for consumer spending is like the highest month of the year. November, December. You would assume that, especially with the GST holiday, which is sort of monkey wrench into any way and how to interpret all of the specific data. I would suggest that when the dust settles from that, the economy will still be soft. The labor market will still be soft. Bank of Canada will be forced to cut interest rates again, despite that they're risking the value of the Canadian dollar versus the Fed, who's not expected to cut.
Yeah. So, Tom, outside of a major tariff war in February, do you think that the consumer spending report should be the number one thing that holds the most weight, or should we be looking more heavily at inflation or job numbers, or do all of three of those things really make the Bank of Canada's decision going forward? Tom, you're muted there, Tom. So I think that it's probably a little bit of all three. I think we'll probably have it's very possible that the Bank of Canada will realize that spending is stronger, but I think that they're also prepared to look straight through that stat, and they'll probably rely more heavily on job numbers, on consumer spending, but also like how do Canadians feel the economy is going? I mean, the trade war is a huge wild card, so I think there's validity to it. I think there's a possibility that the Bank of Canada doesn't decrease rates anymore based on consumer spending being strong, but I don't think that's the stat that the Bank of Canada will hang its hat on.
I think we'll see spending tighten up as well. Because there's so much chatter about inflation being under control, we're still not really highlighting that prices haven't come down. So sure, the prices aren't out of control growing. The price growth has stopped, but prices are still up. We don't have cheap manufactured goods out of China at the rate that we used to. It's a has a big impact on prices in the marketplace. We don't have the inexpensive oil and gas from other parts of the world. So whether we're going to face it right now or not, we're going into trouble until we can open up, sort of the global economy. But if China doesn't want to participate, it's going to be years to build that infrastructure somewhere else in the world so that we get the cost of goods back down.
Tom, what are your thoughts? No, you're still muted, Tom. Well, we'll catch. I was just reading something from the press release here from the Bank of Canada. So they're saying that setting aside threatened U.S. tariffs, the upside and downside risks around the outlook are reasonably balanced. So they're feeling pretty good about where they're at. However, as discussed in the monetary policy report, a protracted trade conflict would most likely lead to weaker GDP and higher prices in Canada, which, if you read between the lines, they're worried about stagflation. I know, which is a weak economy and rising prices.
Yeah, we think
there's no real solution for that.
Thing that could happen to the Canadian economy. And with no solution, well, I can't sit here and make a decent prediction either.
Yeah. Tom, you back?
Am I back?
There we go.
Yeah, I'm back. Great. Yeah, so I don't know. I'm thinking back to my last comment that I was trying to make based on the economist from Scotiabank. But just quickly, I don't want me to go back. But again, this is only one economist out of the top 6, right? That's predicting that we're not going any lower than what we're going at now.
That's right.
And I'm looking at like TD CIPC. They're suggesting another 0.75%. I think RBC was another 0.5%. National Bank was maybe another 0.5 or 0.75%. So I don't know how much. Again, I'm going to go with the numbers, right? So I'm not an expert in their field, and that if we're suggesting that 5 out of the 6 are saying that we're going to be coming down a little bit more, then I'm going to go with that. Now, tying into now, the economy and how does that impact it? Again, if we lower interest rates further and the Federal Reserve doesn't, again, that's going to have a huge impact on our dollar. I just went into the bank the other day, and the bank rate was $1.48. So you can just imagine how expensive it is. And then, we purchased a lot of goods from the U.S. So, we really need to focus on how is that going to look for our inflation and back to what you guys are talking about, stagflation, right? So it's a tricky situation that we're in, and it's almost like we're sort of sitting on the edge of our seat, always waiting to hear what's going to happen down south.
And, so Tom, if you were going to give somebody advice right now, whether to spend, invest, or save, like generally, what's your thoughts? And I'll go first here. I would say save your money right now because the worst we may not have experienced the worst case scenario yet. So I would be conservative with spending.
Yeah, it's kind of like that same question. Who'd you marry? Who'd you kill? And who'd you,
who'd you kiss?
Right? Yeah, who'd you kiss? So I guess it all depends on who you're giving the advice to, right?
Sure.
If you've got someone that maybe has a large family and they're sort of living paycheck to paycheck, then yeah, that could be a different conversation, right? So, but hey, look, we need people to go out and spend money. We need people to go out and, buy those luxury items, luxury cars, right? It's important, right? So I don't want to be the one to tell everybody, hey, look, don't do all that, save your money. But at the same time, it depends on who you're talking to, right?
Yeah. If you've got the beans to do it, and there's some opportunities. While people are fearful, there's always investment opportunities. NVIDIA the other day saying like biggest one day stock drop. The next day it's right back up to where it was, and I think it will continue to go on. So like those little opportunities may be there. If you're looking for a 1-bedroom condo in Toronto, opportunity knocks. There's lots and they're on sale. So
we're saying
act when others are fearful.
Invest or save, but maybe don't spend. But Tom's saying spend. I'm saying don't spend. I'm saying put pressure on the Canadian government, or the Bank of Canada rather, to cut again. If we don't spend on luxury items, they'll be forced to decrease the key interest rate, and we'll be back up and cooking in the real estate and mortgage world.
Yeah, it's crazy. I was at the corner of Queensway and East Mall, and there's a Mercedes dealership on one corner. There's an Audi dealership on another. There's a Volkswagen on this, another corner, and there's just so many cars sitting on the lots, right? And I'm like, who's buying all these cars? Because I look beside me, to the left, to the right, everyone's driving a car that's got to be at least 3-4 years old, and nobody's driving all these fancy cars. And they're all displayed in their fancy windows now that they have. And
but I mean, I don't know, but I'm sure, Tom, that you've seen this mortgage application too, where you're doing the application. It's a couple of younger people. One of them has got a Mercedes lease that he's paying, essentially what would be a mortgage payment, and because of that payment on the Mercedes, they don't qualify to buy a house. So we see a lot of stuff, and there may be a lot of envy out there, but a lot of people are way over leveraged buying these fancy automobiles. You can buy it for cash, sure, but if it prohibits you from investing in your future and real estate, maybe it's not the best play.
Absolutely.
So on the flip side, RBC says that many Canadians are still struggling to keep up with rising costs. So they did a poll, and 48% of respondents say that they can no longer maintain their standard of living or won't be able to get ahead financially. So 50% said they've dipped into their emergency fund or retirement savings to pay bills. So is this rate cut enough to ease the pressure, or is the struggle still far from over? Are we going to start to see those Mercedes dealerships start to fill up with, now that we've had this 25% or 0.25 rate cut?
Yeah, it's interesting. It's it depends on really who they're polling, right? Are they polling people that have fixed rate mortgages from 3 years ago and nothing really has changed for them? And will a quarter point Bank of Canada rate reduction even impact that person until maybe renewal, right? So I guess there's like a broader scope there on who these Canadians are and who they're polling, and are they all variable rate mortgage holders? Are they even mortgage holders at all? So if they're renting right now, how does a quarter point reduction in the overnight lending rate even impact them, right? So
yeah, for sure.
I think
Vaughan,
that
what's your take?
I tend to agree with RBC. I think RBC is got the forecast, similar forecast to me, with the overnight rate going down to 2% by the end of the year. And this is kind of, what I'm sensing, what I'm feeling from the marketplace is that there's still some struggle to go, unfortunately. I want to see a future that's all, get the real estate market moving again, specifically, and get money back into people's pocket, but we still have high prices. So yeah, we're not where we were in for the last decade in terms of mortgage rates. We're still quite high for fixed rates and variable rates. I've noticed the variable rate discounts have dried up as well. Tom's got some good points about who are they polling. I don't know if you heard Donald Trump's opinions on polling and pollsters, but he doesn't put much credence into it. And I could see that. My phone didn't ring. They didn't ask me how
I rang. I just didn't pick it up.
Well, yeah. And so who does pick it up? Maybe they did call everybody, and who's got the time
lonely
to pick
people?
People, the squeaky wheel, right? Are they going to get the grease? I don't know. Probably not. We're not basing economic decisions on who we polled, but it's definitely interesting because the cost of goods are still up, and I don't think that media covers it enough. I don't think that we talk about it enough. Is that sure, inflation is cooled, but it's not the time to throw a parade about it at this point. We need other solutions. We need cheaper energy, and we need cheaper cost of goods in order to bring everything back in line to what we're used to let's say, 2017, 2018, pre-pandemic, where we had money in our pockets, we had low interest rates, and the cost of goods were down.
Yeah, I don't see a quarter point making a huge difference for people who are struggling, week to week or paycheck to paycheck. How many of those people are going to be mortgage holders? How many are going to be variable rate mortgage holders where this would have an immediate impact? But the Bank of Canada is trying to stick a landing here where we don't, speed up the economy too much by reducing the interest rates. And so trying to play this correctly is going to be a bit of a circus act here, I think.
Well, especially with that GST holiday, right? You throw in something new to the mix, and because it's encouraged spending, and I think that they've seen that, like restaurants and bars and stuff. And I mean, so that's good for the economy to get support to those industries. But like, where is it going to shake out with the new president, with all these little changes? It's going to be interesting next few months. I guess we find out more about tariffs as early as Monday.
Saturday, February 1st.
Well, Saturday's Feb 1, but Trump will definitely tweet on the Saturday, but will there be new policy over the weekend in the States? Do they?
Yeah.
I'm not familiar with that.
We'll see. I mean,
it's
one other thing that. Go ahead, Tom.
It's funny. He uses it as a negotiating tactic, right? And again, I had a conversation just the other day or yesterday about how he was going to send all the illegal immigrants back to Colombia, and Colombia was like, "No, we don't want them. Keep them there." And
they refused.
And then Trump said, "Fine, we'll put a 25% tariff on you." And then they're like, "Hey, we'll send the plane out there to go pick them up. Don't worry about it. Don't be sending."
We'll be there in 20 minutes.
And we'll raise it to 50% if you don't comply within a week or something like that.
I just don't think he's thought this really through, right? Like, I think his big. So he's like, well, look, we're trying to get American jobs back again. If you don't want those tariffs, then, start building factories down here and start, employing people down here. And everybody knows that's not just overnight that you just all of a sudden put up a factory and have workers and change the logistics of how certain things run. Right. So, and the tariff is going to be put on place on the buyer. It's not us who's selling it, right? So it's going to impact their costs down south. And for how long? Like, it could be short term, 6 months until maybe they find another supplier. But a lot of these suppliers have contracts with Canadian companies, right? It's not like you could just say all of a sudden, "Hey, look, we're not buying your steel anymore. Or we're not buying your lumber anymore. We're going to go to this new company that's now in the U.S. That's right." So I think he's trying to scare a lot of people, and I hope I'm right that he's trying to scare a lot of people, but we'll see.
You mean you hope you're right, and that he's not actually planning on pulling the trigger or executing these harebrained schemes?
Yeah.
I mean, his advisors.
And then what happens if he doesn't, right? If he doesn't put the tariff on, then everyone's going to be cocking eyebrows and be like, how much is this really true? Right?
Is he crying wolf?
Yeah. Right.
Yeah.
Like you did change the Gulf of Mexico to the Gulf of America already, but it's,
I don't think you couldn't make this stuff up,
No, you can't, right? So I don't know. It's going to be interesting to see. I can't wait till February 1st comes and goes, just so that way we can, all this weekend take a sign of relief, right? And just be like, this guy's just full of himself, and he doesn't really think things through before he talks.
Well, it's the American consumer that's paying the tariff, right? It makes the Canadian goods less attractive, but it's not the Canadian government that pays the tariff. It's the American consumer buying that Canadian good that makes, and that cost is 100% passed on to the consumer. So they either pay for that Canadian good with the tariff, or buy an American good, which would be equally as expensive, or you go to another source outside of. So if, say, you're buying now Venezuelan oil,
right?
That's not stable.
Yeah.
Is the product is good? Is the infrastructure is good? Do they have it set up where they can get it? It's just, it creates all sorts of problems for the U.S. consumer, the U.S. industries as well. I can't see it going on forever. I think he's going to do something similar to, I just don't think he's got the same hammer that he has with Colombia, right? So Colombia is saying that, oh, we're not taking our people. Well, we're going to put 25% tariffs on. That's like, you don't do this, then we're going to do that. Okay, you're going to do it. We're not going to put the tariffs on.
He's a bully.
There's no Canadian situation like that right now.
No.
Yeah.
No, and his advisors are already on the record for saying that, specifically with Canadian automobile manufacturing, that there's no replacement for it in the U.S., that the U.S. citizens would just be forced to pay more for Canadian, because we'd still be underpriced compared to other countries, but they're just going to have to pay 25% more. So they're advising against it. So I think that we'll see a real rolled back version of tariffs if we see the tariffs. It's contingent upon border security and stuff. So if we make a promise that, or even just a statement, oh, we fixed the border security, then it sort of gives him permission to move away from it. He can say, look, I won what I wanted to win. Canada has increased their border security. I've done what I said. Right. So then he can move away from the tariff conversation about Canada. With Colombia, I don't know. We spend a lot of time doing research just on the Canadian market. You think I'm going to be a foreign market expert on top of that, as well as a
you got this, Vaughan.
I mean, come on.
Vaughan's our Colombian foreign correspondent.
Yeah.
Yeah. I think the podcast is going to pay to send me down there.
Okay, I got to change the topic here. So Donald Trump also just made a bold statement about interest rates, saying when he's president, he'll demand an immediate drop to the federal rates. And not just in the U.S., he thinks rates should fall worldwide. Because a statement like this actually influence mortgage rates here in Canada. What do you think it means here in Canada? And what does it mean for homeowners and potential home buyers of properties?
Well, I don't think Trump really has, he can yell and scream as much as he wants to have interest rates come down, but it's not really up to him whether the Fed Reserve reduces rates or not. So, but I would love to see the American for the overnight lending rate from the Fed Reserve come down for sure. Because right now, if you look at it, we're at 3%. They're at 4.25%, right? So if you're going to buy, if you're going to be buying bonds here in Canada, would you rather buy them at, let's say, 3%, or would you rather buy them at 4.25% in the U.S., right? So if you're buying them more in the U.S., guess what's happening? The dollar is more attractive in the U.S. There's more investment coming into the U.S., right? So once we start seeing that the Fed and the overnight lending rates are closer in line with each other, maybe we'll start seeing some of those investments coming back into Canada, and once we start seeing more purchases into our bonds, then again that's going to stimulate the economy, and that goes back to our first point where I don't understand why they just announced today that they're going to be pausing on what did you say, economic
quantitative tightening.
Exactly, right?
Yeah.
So it just seems weird. I just don't know. Again, I'm not an expert in the field. I'm not with the Bank of Canada, and
we're not experts, Tom, on the economic side of it. But on this podcast, we pretend to be. So just let it fly. Have a good time. Nobody's holding us.
I shouldn't say we. I should just say I'm not an expert. I'm sorry to bring you guys down with me.
No, I mean you need a specific degree in economics to be considered an expert, and I think we have business degrees, but not specifically in economics. So we just go ahead and give our predictions here, and I don't think that we have a mailbag, where we get letters that people. If they have a beef with
written letters,
so far,
postcards.
Nothing yet. So,
but so I mean, he's also threatened about removing Jerome Powell as the Federal Reserve chief. I forget his exact title, but removing him, and then like he's doing in other places, he's putting his people in charge there, which could essentially, he could then pull that lever and like I told you to, which I think is very dangerous, that it's not independent of the government.
Trump called him a putter or a golfer who couldn't putt. Now, Trump appointed Powell, and Powell also has said recently that it would be illegal for him to be fired by the president. But you're right. It definitely opens up a conversation of what happens if he does. So as far as we can understand, the leader of a country doesn't affect mortgage rates, doesn't get to play around with policy rates, and fixed rates are based off bond yields. So we don't even know the lever that you'd have to pull because it's never really been done in that in that regard. And Powell's saying, well, you can't tell me what to do or fire me. So
you can't fire me.
Like where it's from an economic financial perspective, I haven't seen anything like this.
Well, and it's important for it to not be influenced, right? Like it's the most important currency in the world, and the fact that it is stable and it's a pillar, it makes the world go round essentially right now. If all of a sudden it's not as safe, that throws everything into turmoil. I mean, theoretically, lower interest, the Federal Reserve lowering interest rates would lower our interest rates here in Canada, but it also is going to make things artificially more expensive as people spend more and inflation goes up. So I don't think it's a great look. It's not something that you should be saying that we're going to essentially destabilize the currency in any way, especially the U.S. currency. I just don't think it's a smart move.
Yep, I'm going to agree with that. And it's certainly unprecedented to even hear about, the interest from a government head to get involved on that level, way out of his league.
Yeah. So I've got one more topic for you guys. So let's see here. So for years, we've been talking about Canada's housing crisis and the need for more homes, but new data from Oxford Economics just flipped the script. So with the projected population decline for the first time since Confederation in 1867, experts are saying that we might need 500,000 fewer homes by 2035 than originally thought. Is this a game changer? Doesn't matter? Is this allowing us to take a breath? Are we still headed for trouble? Vaughan, what's your take on that?
Well, I'll go right ahead and get as weird with it as I can. By 2050, the global population is expected to turn around and stop growing. So, there's theories there. But if we really
just wait for 2050.
Well, hopefully we're not that far away from it. We'll actually get to measure that stat and see if it goes that way. But if global warming and climate change is expected to be as destructive, as some of the predictions are in those warmer parts of the world, even if there's a population decline somewhat, I could see Canada, if Canada warms up a little bit, we'll get bigger growing conditions, and we'll sort of undoubtedly take on more and more people from other parts of the world that are uninhabitable to come here and work and hopefully grow vegetables and agriculture, and Canada could be a completely different country. So if you go on that weird line, then you would say no, the population will not decline. We should keep building. Build now, ask questions later.
We just got to get rid of this pesky winter, is what you're saying.
Well, I mean, we won't be
and
doing
the Canadian shield as well, which makes it a little bit difficult to grow.
A little bit difficult to build up there.
Yeah.
Tom, what do you think?
And grow. I just think whenever it comes to population and it comes to housing, I think that they're just headlines, right? It always seems like whatever makes the front page, right? So I really don't have an opinion on it. To tell you the truth, I don't even know, how much truth is it to what they're trying to say as opposed to what their predictions are, right? You can go back 10 years from now or 10 years ago, and building housing was always an issue, right? And even the projections back then about how we won't have enough housings for the population, but that's going to take 10 years just for us to catch up. So
Sure.
For them to be able to predict down the road that we won't have we'll have too many housing for the population.
Well, that we'll need 500. We won't need to build that additional 500,000 houses.
But we're still playing catch up right now, right? So why don't we talk about that? Why don't we talk about that once we're at once we've caught up and we're like, okay, now we've built too many, right?
And we're playing catch up while our population is supported primarily by immigration, right? So Canadians aren't reproducing at any kind of substantial rate to repopulate our country. So we could argue already that we're on a population decline if not supported by immigration, and we're still in this housing crisis. So I would say keep building. We're never going to be able to outbuild this problem as far as I can see.
And there's the option of becoming the 51st state and bring some people from the U.S. up here if we had to.
Well, then we need to build even more.
Yeah, we need to keep building. Essentially, I don't see a situation where it's like, okay, we've solved this. We're not inviting as many people in. The population is declining. I still think we need to keep building infrastructure. The services need to be there. Let's have world-class infrastructure, transportation, housing. Let's start to expand and make this a livable city for more and more people, and then we can get back to inviting more people into the country, because we need, as you guys both mentioned, birth rates are declining here in Canada. We're not growing enough of our own people. We need those people to come in and pay for our expensive social services that we have. So I see that as the future. I don't see how they stop building.
Yeah, I think people coming over here. Oh yeah, go on.
No, go ahead.
I think people coming over here don't realize how expensive it is, and it's the people that are already here. That's why the birth rate's declining, because they're like, man, it's too expensive to be having 2+ kids anymore, right?
Yeah,
but, that was just a quick little comment.
Let's continue building. I think we're all in agreement. 500,000 fewer homes. That's amazing. That gives us a little bit of a breath, but let's keep up the construction. Let's keep that going. We can do one more. We can talk about the stress test maybe and how that might affect things, or maybe let's save that for next time. Do you guys have anything you want to add before we go?
No, we're 42 minutes in. Tom, it was great to have you on. We'll have to do this again. It's always fun to have a third host on the show too. So
that's awesome. Thanks, guys. I appreciate it. This was a lot of fun.
Absolutely. All right. Well, let's do it again soon, Tom, and see you next time on the Mortgage People podcast. If you're not subscribed, please subscribe, and remember to like and comment, and we will see you next time.